Hello, I'm Hunsley of Livewire Markets, and welcome back to another episode of The Pitch. Joining us now is Colin Mackay of Cromwell Property Group. Colin, investors have cooled on office properties, but are you still finding opportunities in the space?
Oh, we're definitely seeing opportunities across office, and I think the key driver of that is the repricing that we've been seeing occurring, particularly in the second half of this year. Unlike other sectors in commercial property where valuations have been a bit stubborn, we have seen offices reprice, and that means that it's actually starting to offer quite attractive yields. And unlike the fixed income of a bond, for example, that cash flow that you generate through rent can grow over time. So you're getting that attractive yield, but I think some of the impacts from work from home probably overstated a little bit, and so that rental growth and the income growth that you can achieve is actually a little bit more positive than investors might be realising as well.
Okay, so there are lots of different types of office properties. I mean, you got premium, you got your A grade, B grade, and so on and so forth. Is there a specific part of the market you are viewing more favourably right now?
We think fringe markets are offering some good opportunities. So when I say that, it's kind of on the edge of CBD. So they're still central locations, and they still benefit from transport, amenity, tenant agglomeration. But it's generally a little bit harder to bring new supply into that kind of market. So we see, good demand drivers there as well. The physical characteristics of the buildings in these kind of markets, they also tend to be a little bit more aligned to smaller occupiers, which is a segment of the occupier market where we see actually, better growth fundamentals. And then as well, the kind of industries that are attracted to those kind of markets, they tend to have a higher propensity to use the office. So we think that'll provide a tailwind to demand moving forward as well.
So working where you are in commercial property, obviously the narrative has changed so much since COVID. But I'm curious to find out from you how and why that narrative has changed, and now how do you plan to take advantage of the opportunity?
Yeah, well, I think the narrative has certainly become deeply pessimistic, and I think that maybe evolves from two main things. One is a bit of a misunderstanding as to the extent of space impacts that work from home will result in. Even if we're working in the office, 3 days a week, and so that's a reduction compared to the 5 days pre-COVID, you're not going to see the same extent as that in terms of space impacts, because you still need to account for fluctuations in office occupancy. And the other thing probably is a bit of an underappreciation of how elevated construction costs are right now. We're seeing competition for labour and materials from infrastructure projects, residential projects which still can't get out of the ground, industrial, and so that's going to make it really hard to bring new office supply into the market. So Australia's long-term population growth story is going to counteract that and eat into any of that kind of excess stock that has been created from work from home.
Well, you could say the same thing about residential property too, probably.
Absolutely.
So I find it interesting that you've said recently that opportunities exist where sentiment is not aligned with fundamentals. So I'm curious, what does that phrase, if you like, what does that mantra actually mean? Why is it important? And can you give an example of what that looks like?
All office has kind of been tarred with the same brush, so to speak. Yes, headline vacancy is quite elevated, but you've got more than half of CBD assets that are 95% plus occupied. So they're not really seeing an impact. And if you take a market like Surrey Hills in Sydney, vacancies at 7%. So that's less than 1 percentage point higher than the long-term average. But it's being priced as if it has the same supply-demand fundamentals as the broader market. And that's just simply not the case. So that's where we see the sentiment is kind of operating at that broader industry level, and that's moved far beyond the underlying fundamentals of specific assets or specific markets that have different underlying characteristics.
Okay. So when you identify and ultimately make that investment decision into an opportunity, what are some of the things then that Cromwell does to improve the property? What do you do to generate a better return for investors?
Well, a lot of that comes down to the underlying bricks and mortar, right? And it can range, there's a whole spectrum of things, and it can be something a bit quicker and easier, like improving the look and feel of an asset, how it presents. It can be something a bit more substantial, like incorporating end-of-trip facilities, third spaces. It could be ESG initiatives, waste, water, energy consumption reductions. I would say probably over the lifetime of an asset, one of the most important things we do is make sure we're efficiently deploying capital expenditure. And that's both on a maintenance and an improvement side of things, making sure the right plant and equipment is getting upgraded at the right time in the cycle, that you're getting the best bang for your buck, that you're improving operational efficiency as much as you can. And I'll probably say as well, having a leasing strategy is super important. And that's not just about addressing current vacancy, that's really about having a plan across the whole expiry profile. And that really comes from having deep market experience and understanding about how your asset sits in that market.
Right. Colin Mackay of Cromwell Property Group, thank you very much for joining us. And thank you for joining us for another episode of The Pitch. If you like that and you want to see more, you can go to livewiremarkets.com and our YouTube channel. Thank you for watching.